Welcome to the Deep Dive. We're your shortcut to understanding complex ideas without all the usual information overload. Today we're doing something pretty interesting. We're taking a deep dive into some insights from Wealth in Motion, specifically their first episode, We Don't Sit Still. Our mission, like always, is to pull out the really key nuggets of knowledge, maybe some surprising facts from these sources, and help you rethink why that traditional way of managing money, the passive way, why it might actually be costing you. So get ready. This is designed to really shift your perspective on financial growth, on financial activity. Because honestly, the whole premise of Wealth in Motion, it challenges so much of the financial wisdom we've kind of grown up with. And that's where it gets really compelling, I think.
It really does. And what's fascinating here, what these sources do so well, is they completely reframe, they reframe the very idea of financial safety and risk. They guide us towards something more active, more intentional, a strategically driven approach to our money. It's a big shift philosophically, but it has huge practical implications for everyone listening, really, no matter where you are financially right now.
I couldn't agree more. I mean, think about it. How many times have you heard, maybe not in these exact words, but the idea, save your money, play it safe, don't take risks?
All the time. It's the standard advice.
Right. This conventional wisdom, like the sources say, it basically tells you, just sit on your money, park it, protect it. For generations, that's been sold as the way to achieve financial security. It feels prudent, doesn't it? Responsible, even.
Absolutely. You work hard, you earn, you stash it away. Safe. Theoretically safe, anyway. Like building a little fortress around your cash.
Exactly. Building a fortress.
But that advice, it almost always comes from a very understandable place, a desire for security. It's about minimizing the chance of immediate loss, avoiding that sting of a bad investment or a market dip.
Makes sense.
But here's the kicker. Wealth in Motion argues that this defensive stance, while it looks smart on the surface, it actually overlooks some fundamental financial realities. It kind of assumes the world is static. That money can just sit there, untouched, indefinitely, without any downside.
Which, as anyone watching the economy or just, the price of gas knows, is definitely not the case. The financial world is anything but static.
Precisely. It's a dynamic. It's constantly shifting.
And that's the crucial point, isn't it? If you stick too rigidly to that park it idea, even though it feels cautious, you could actually be hindering real wealth building. You end up missing opportunities for growth. And often those missed opportunities, long-term, they can outweigh the safety you thought you had by just sitting still. We've all heard those sayings, a penny saved is a penny earned. Don't put all your eggs in one basket. Wealth in Motion isn't saying those are wrong.
No, not at all. They're foundational.
Right. But it's arguing they're incomplete. There's this missing layer, this dynamic layer that maybe we haven't fully grappled with. It's not about saving instead of moving. Maybe it's saving so you can make intelligent moves later.
And that missing layer, that's where this concept of silent erosion really hits home. The source material puts it very bluntly. Money sitting still is money losing ground. It says, inflation eats, time erodes, and opportunity moves fast. And this next part is key. When your money isn't doing anything, it's actually doing one thing really well, losing value.
Wow. Okay.
Whether it's inflation or opportunity cost in action comes with a price. It's not just a tiny loss. It's this steady, relentless drain that compounds.
Let's really dig into that, because I think for a lot of people, really getting this is a huge aha moment. So first, you mentioned inflation. We all know prices go up, but the sources frame it as an invisible tax.
An invisible tax. That's a good way to put it.
It just constantly chips away at the purchasing power of your idle money. And we're not even talking about crazy hyperinflation scenarios. Even a normal inflation rate, like maybe 2 or 3% a year.
Which is often the target. Right.
Exactly. Even that, compounded over years, decades, it seriously erodes what your money can actually buy. Think about it. What $100 bought you 10 years ago versus today, groceries, gas, whatever, it just doesn't stretch as far, even if the $100 bill looks the same.
It's a guaranteed loss on idle cash, non-negotiable.
And this isn't some abstract theory. It hits your daily life, your retirement plans. It's real.
Absolutely. And then there's the other side of that coin. Time erosion. This is about the opportunity cost of compounding. It's not just inflation making things more expensive. It's the lost potential for your money to grow exponentially.
The magic of compounding.
The magic, exactly.
Yeah.
Often called the eighth wonder of the world, right? Is where your returns start generating their own returns, and those returns generate more returns. It's this incredible snowball effect.
Yeah. It's powerful stuff.
It's the main engine for long-term wealth building, but if your money is stagnant, that engine is completely off, switched off, The longer it sits idle, the more compounding potential you just lose. Forever.
So you're not just losing buying power to inflation.
No. You're losing the opportunity for your money to actually multiply itself. Let's say you have $10,000. In a savings account earning, what, maybe 0.5% these days? Over 20 years, it barely grows. But invested, maybe earning an average of 7%, that same $10,000 could become over $38,000.
Wow. That's a huge difference. Nearly $28,000 just gone. Poof. The cost of doing nothing.
Exactly. That's the opportunity cost of not compounding.
And then there's the broader idea of just missed opportunity. Money sitting idle in a checking account, it's literally unavailable to jump on new chances that pop up.
Okay.
And that's not just stocks, right? It could be investing in a new tech startup or maybe launching a side business you've been thinking about.
Or even investing in yourself, taking a course, getting a certification that boosts your earning power. That's putting capital to work too.
That's a great point. So this opportunity cost is the value of the next best thing you didn't do because your money was just sitting there. You chose perceived safety, maybe, but wealth in motion says you sacrifice potential. Big potential sometimes. Like, think about market downturns.
Oh, absolutely. Those with capital ready, in motion, can buy assets when they're undervalued, setting themselves up for big gains later. If you're stagnant, you just watch it go by.
Right. You're on the sidelines.
So if you connect all these dots, inflation, time erosion, missed opportunities, it becomes really clear. Inaction in finance, it's never neutral. It's an active choice. It has real measurable costs, often much bigger costs than the risk of making a smart strategic move.
It forces you to really question what safe even means anymore.
Yeah.
Is it safer to watch your money shrink slowly or take calculated steps to grow it?
That's the core question Wealth in Motion poses. It challenges that whole traditional notion of safety.
So let's pull this together. What does this mean for you, the listener, trying to make smart choices? It sounds like doing nothing is actually, well, pretty expensive. The sources are emphatic. Doing nothing is sometimes the riskiest move of all. And wealth doesn't wait, so neither should you. Also, playing defense only gets you so far. This feels like a major shift from standard advice.
It is. It's a complete flip of the script. That perceived safety of inaction, that cozy feeling, it gets dismantled. It reveals that the risks of losing ground to inflation, missing growth, those can easily outweigh the calculated risks of making a strategic move. And let's be clear, this isn't about being reckless. It's not saying go gamble it all away.
Right, important distinction.
It's about a smarter, more nuanced view of risk. We're just standing still. Stagnation itself carries a really high, often hidden cost. You have to ask, what's the real price of that security if it means you're actively losing value and future potential? Risk applies to doing nothing just as much as it applies to doing something.
You know, it makes me think, this idea, this redefinition of risk, it goes beyond just money, doesn't it? Like, think about your career, your human capital. If you stop learning, stop adapting, you risk becoming obsolete, right? Your earning potential erodes.
That's a perfect analogy. You're stagnating professionally.
Or even socially. Your social capital, if you stop networking, stop engaging, you miss connections, opportunities. It's like planning the perfect workout, but never actually going to the gym.
Right.
While you're planning, your fitness isn't static. It's likely declining. Doing nothing is an active choice with consequences.
Exactly. It's never passive. Which leads us perfectly into what wealth in motion actually means by motion. Because the sources are very careful here. They say motion doesn't have to mean reckless. It means intentional, strategic, focused.
Yeah, intentional, strategic, focused. Not just random busyness.
Precisely. And they add true wealth. It grows when it moves, when it's placed with purpose, backed by insight, and allowed to work. This distinction is critical. It separates purposeful action from just, impulsive gambling or chasing trends. It's about the quality of the movement.
Yeah, that's huge. It's not about frantically trading stocks based on headlines or jumping on every crypto coin someone mentions online. Wealth in motion is talking about disciplined, thoughtful, well-researched deployment of your capital. Understanding the where and the why behind your financial decisions.
Aligning those decisions with your actual goals. Retirement, house deposit, whatever it is for you.
Right. It's about designing systems for growth, not just making random transactions. That's what makes it actionable for you, the listener.
And that raises a really practical question for you listening. How do you define strategic for yourself? It's the difference between, say, just dumping every spare cent into a savings account where inflation eats it, and actively looking for opportunities where that money can do more, contribute to a bigger plan.
So being strategic means what? Evaluating options, Understanding risk.
Yes. Understanding the risks and potential rewards. Making choices that fit your vision but are also grounded in reality and good analysis. It's about being the architect of your financial future, not just a bystander hoping things work out. It needs learning, adapting, being proactive.
Okay, so if that's the philosophy, what does motion look like in real terms? What are the actual moves? The sources give some really concrete examples. Cash flow, compounding, reinvestment, income stacking.
Even just automating your deposits or rebalancing your portfolio, these are moves, and moves matter.
Right, and it adds, money shouldn't just sit there, it should circulate. Through cash flow, through smart risk, through assets that grow while you sleep.
Yeah. What I love here is that these aren't just for the super rich, are they? These are things regular people can actually do. Absolutely. Let's break them down. First, cash flow. Wealth in Motion talks about this as the constant, deliberate circulation of money, not just letting it pile up. It's about making sure money flows through your financial life purposefully. Maybe optimizing your budget frees up cash to invest.
Or maybe aggressively paying down high-interest credit card debt. That frees up cash flow too, right? Money that was just going to interest payments.
Exactly. That's optimizing cash flow. It's about directing the flow, making sure it serves a purpose. They might even suggest looking at good debt versus bad debt. Is your debt helping you grow assets or just draining cash?
Interesting distinction. Okay, next, compounding. We touched on it, but it's worth repeating.
Definitely. Because this is where motion really turns time into your ally. Your earnings generate more earnings, which generate more earnings.
It's that snowball rolling downhill, getting bigger and faster.
Right. Your initial investments are the core, but the returns become new workers, generating their own returns. Wealth in Motion really stresses that even small, consistent amounts.
Like $100 a month.
Yeah, even $100 a month, invested consistently over decades, can grow into a huge sum thanks to compounding, but it needs that initial motion. Without it, nothing compounds.
Makes sense. And closely related is reinvestment, right?
Directly related.
Yeah.
It's putting compounding into action. You take the profits or dividends or interest you earn, and you put them back to work systematically. You don't just pull the earnings out and spend them or let them sit idle. You reinvest them to buy more of the asset or maybe diversify into something new.
So if you get dividends from stocks, you use them to buy more shares.
Exactly. That's automatic reinvestment. It keeps the money in motion within the growth system. It accelerates everything. It's a fundamental move.
Okay, what about income stacking? Sounds interesting.
It is. It's about creating multiple streams of income, not just relying on your main job. Wealth in Motion sees this as building resilience and creating more capital to put into motion.
So like a side hustle or rental income or maybe royalties?
Precisely. Or passive income from investments. Each extra stream provides more fuel for growth, makes your whole financial picture more robust, less dependent on one source.
More potential moves you can make. Got it. What's next? Something simple.
Yes, deceptively simple but powerful. Automating deposits. Wealth in Motion loves this because it takes emotion and inertia out of the equation.
The I'll do it later trap.
Exactly. You set up automatic transfers, say from checking to an investment account every payday. It just happens. You build the saving and investing habit without needing willpower every single time. It ensures money is constantly moving, even small amounts. It's foundational.
I like that. Effortless motion. Okay, for people already investing.
Rebalancing your portfolio. This is active management. It's about periodically adjusting your mix of assets, stocks, bonds, whatever, to stay aligned with your goals and risk tolerance. Say your stocks did really well, and now they're a much bigger chunk of your portfolio than you intended. Your risk level has crept up.
So you'd sell some stocks.
Right. Sell some of the winners and maybe buy more bonds or other assets that haven't performed as well to get back to your target mix. It shows that even long-term investing requires motion. It's not purely set it and forget it. It's active stewardship.
Okay, managing the mix. Then there's smart risk. How is that defined?
Crucial one. It's the absolute opposite of reckless gambling. Smart risk is calculated, understood, aligned with your goals. It means doing your homework, researching opportunities, knowing the potential upside and the potential downside.
So not just chasing hype.
Definitely not. It's taking informed, measured chances where the odds are reasonably in your favor. Think investing in a diversified index fund versus putting everything on one speculative stock you heard about online. That's the difference.
Gotcha. Calculated versus craziness. And finally,
assets that grow while you sleep. Passive income generators. The sources mention traditional things like dividend stocks or rental properties, but also newer plays.
right, they mentioned staking and decentralized finance, DeFi. Can you quickly explain those for listeners who might not know?
Sure. Staking, usually in crypto, is like locking up your digital assets to help run the network. In return, you earn rewards, kind of like interest. It supports the system and pays you back.
Okay, so it's active participation earning a return.
Yes. And DeFi, decentralized finance, it's this whole ecosystem using blockchain, trying to bypass traditional banks. Think peer-to-peer lending, borrowing, trading, often with potentially attractive yields.
But also different risks, I imagine. Tech risks, market risks.
Absolutely. Higher potential returns often come with higher, or at least different risks. The key, as Wealth in Motion would stress, is understanding how these fit into a diversified, calculated strategy. They're potential moves, tools in the toolbox, not magic bullets. The goal is assets working for you, generating returns passively once set up.
Okay, that's a great breakdown. And the big takeaway here is these aren't just for the Wall Street pros. Cash flow, automation, even understanding things like staking. Yeah. These are accessible moves for regular people.
That's exactly the point Wealth in Motion drives home. People think wealth building is one giant leap, right? Win the lottery, invent the next big thing.
Yeah, the overnight success myth.
But the sources say much more often it's dozens, hundreds of tiny, consistent movements, habits, systems, small, calculated risks taken again and again. They compound.
And that really tackles that fear of overwhelm, doesn't it? It counters the get-rich-quick idea. Sustainable growth comes from persistent, disciplined, often small actions. These tiny movements build momentum. It's about habits and systems, not luck.
Precisely. It makes the whole idea of wealth in motion feel achievable. You don't need to be an expert today to start making progress today.
Which leads perfectly into the next big barrier they talk about, the perfection trap.
Ah, yes, the perfection trap. The sources nail this. Let's talk about perfection. It's the trap that keeps a lot of people stuck. Waiting for the right time, the perfect investment, the perfect income level. It's a huge reason people do nothing.
Oh, absolutely. I think everyone can relate to that. That fear of making a mistake, wanting everything to be just right before you start, or feeling like you don't know enough or don't have enough money yet.
Analysis paralysis.
Exactly. You get stuck analyzing, planning, and you never actually do anything. And while you're waiting for perfect, what's happening?
Inflation is eating your money, time is eroding potential, opportunities are passing you by. The cost of waiting is real.
You're so focused on the perfect launch, you never actually lift off.
It's ironic, isn't it? The pursuit of perfection actually leads straight to stagnation. It feels like safety, but it's really just missed chances and guaranteed erosion. The market doesn't wait for perfect. It rewards action, imperfect action, often.
Which brings us right to that core mantra of the whole series. It's simple, but really powerful. Motion beats perfection every time.
That's the heart of it.
The sources say, wealth doesn't reward perfection. It rewards momentum. Even a small step forward beats standing still. Honestly, that feels like more than just financial advice. It's kind of a life lesson, right? Motion beats perfection.
It really is. It captures this fundamental truth. Action and progress matter more than endless tweaking and waiting for the stars to align perfectly. The financial world doesn't pause for you. So, starting with an imperfect plan, learning, adapting as you go, that's way more effective than having a flawless plan you never actually execute.
It's like fitness again. The perfect plan gathering dust is useless. But just walking every day, even if it's not the optimal workout, that yields results.
Exactly. Consistent motion, even if it's not perfect, creates momentum. It builds habits. It leads to progress. Standing still guarantees zero progress.
It's about embracing good enough to start, knowing you can improve as you go.
Yes. That idea of action over optimization, it encourages you, the listener, to understand that a simple plan you actually do is infinitely better than a complex, perfect plan that stays on the shelf. Cultivate a bias towards action. Learn from what happens. Adapt. Don't wait for certainty in a world that's inherently uncertain. That's how you start without feeling like you need a PhD in finance first.
So, okay, how does Wealth in Motion help people actually do this? Put this into practice. They say the series aims to break down real strategies from income stacking to automation, from traditional vehicles to newer plays like staking and decentralized finance. And they promise practical, powerful steps to get your wealth in motion, not gimmicks, not hype. It sounds appealing.
It really does. And that commitment to practical real-world strategies is what makes it stand out, I think. It's not about chasing risky fads or get-rich-quick schemes. The focus is on building sustainable systems, good habits, grounded in proven principles. It's about giving you actual tools, not just empty promises, building financial muscle, not just chasing sugar buys.
Yeah, connecting that to the big picture, it's about enabling long-term sustainable growth, building something resilient that can handle bumps in the road, rather than just aiming for quick, flashy wins that might not last.
Exactly. It's a blueprint for enduring prosperity.
And this leads to what they call the core purpose, helping listeners shift from a static savings mindset to a dynamic growth mindset. They call it a key transformation, going from stagnant to strategic. Because playing defense only gets you so far.
And that's a fundamental shift. It's not just about piling up money anymore. It's about making that money productive, actively managing its deployment for growth. Savings are crucial, yes, for emergencies, for stability, but wealth creation, according to these sources, requires putting that money to work purposefully, intelligently.
So actively deploying capital for return, not just hoarding it. It's the difference between a vault and a well-managed farm, maybe. One just sits, the other produces.
That's a great analogy. Comparing the safety of a savings account where we now know value erodes with the active management and potential growth of strategic investments.
Okay, let's make that even more concrete. What does this dynamic growth mindset look like day to day? It's being proactive, right? Not reactive.
Absolutely. It's constantly asking, is my money working as hard as it could be? Is this dollar in its best possible place right now?
So maybe it means once your emergency fund is solid, you automatically transfer extra money to an investment account, not just savings.
Or it means actively researching opportunities that fit your goals and risk tolerance instead of just waiting for advice.
Seeing your money like a team of employees, and your job is to give them the most productive tasks.
That's a fantastic way to put it. You're the manager of your capital.
And the great thing, as you said earlier, is that this applies to everyone. The show aims to provide momentum, something you can apply immediately whether you're earning $500 a month or 50K.
That universality is key. The principles of motion, compounding, strategy, they aren't just for the rich. The scale changes, the specific tools might differ, but the underlying concepts work across the board.
Totally. Automating $25 a week is, in principle, the same move as a millionaire rebalancing their portfolio. It's about that consistent strategic action.
It empowers everyone. It reinforces that even a small step forward beats standing still, no matter your starting point.
So let's wrap this deep dive up. The core message from Wealth in Motion seems crystal clear. Wealth doesn't wait, so neither should you.
And that killer takeaway, the mantra, motion beats perfection. Every time.
Absolutely. So we really encourage you, listening right now, take a moment, think. What's one specific, small, consistent move you can make starting today to get your wealth in motion? Even just setting up that first automated transfer, it's a powerful start. It sets things in motion.
And maybe leave you with this thought. If inaction really does have a cost, these hidden taxes of inflation and missed opportunity, what might you be unknowingly paying right now by just waiting? And what would it look like for you to truly redefine financial safety, not as stagnation, but as dynamic, intentional motion? How could that shift your whole approach to building a secure future?
It's a powerful shift in perspective, something to really think about, and hopefully something that gets you moving.